It was supposed to be a bank that catered to the rich and famous, with clients including tech moguls, celebrities, and even former presidents. But things took a turn for the worse when on one fine spring morning, First Republic Bank, the latest regional lender to buckle under the weight of rising interest rates, collapsed under its own weight. In today's video, we are going to unravel the history of First Republic Bank. We'll tell the timeline of the banking failure. We'll expound on why did the bank fail, and we'll reveal what this failure means for you. But first, stay up to date on the latest economic insights and analysis by subscribing to our channel. Join our community of savvy investors and business enthusiasts who never miss a beat in the ever-changing world of finance. Picture this. It's 1985 in San Francisco, and a man named James H. Herbert II has a vision for a new kind of bank. He wants to focus on lending to those looking to buy luxury homes, second homes, condos and co-ops, and investment properties. And so, he creates First Republic Bank. The bank quickly earns a reputation for its personalized service and exclusive focus on high-net-worth clients. But that's not enough for First Republic. It wants to be a full-service bank. So, in the late 1990s, it expands to the West Coast and then to the East Coast, adding new services and markets. But First Republic never forgets what made it successful in the first place: fewer customer accounts with more individualized service. In 2007, it merges with Merrill Lynch, only to be acquired by Bank of America in 2008. But that's not the end of First Republic's story. In 2010, James H. Herbert II raises private equity capital and secures regulatory approval to buy back First Republic. The bank is back to where it started, a place where luxury homes and personalized service reign supreme. But what happens next? This might shock you. How a bank, which was doing wonders, suddenly started crumbling. Before moving further, we would like you to ask again to subscribe to our channel. It all started on December 31st, 2022, when First Republic Bank seemed to be in good shape, meeting all the capital ratio requirements to be deemed well capitalized. But little did anyone know, the bank had already borrowed a whopping $14 billion from the Federal Home Loan Bank Board, FHLB. Fast forward to February 28, 2023, when First Republic's annual report revealed that the majority of its loan portfolio was secured by real estate and concentrated in California and the San Francisco Bay Area. In addition, the bank had been losing deposits to higher-yielding products and asset classes due to rising interest rates. The alarm bells started ringing on March 6th when First Republic's stock plummeted by more than 75% within days and never recovered. Things went from bad to worse when the FDIC closed Silicon Valley Bank on March 10th, and First Republic began experiencing unprecedented deposit outflows. By March 12th, the FDIC had closed Signature Bank, and First Republic's credit rating was downgraded by numerous credit rating agencies from March 15th to 17th. On March 16th, 11 banks contributed $30 billion in uninsured deposits to boost First Republic's liquidity, but by March 31st, the bank had borrowed a staggering $105.4 billion from Federal Reserve and FHLB funding. Come April 24th, the bank had lost almost 41% of its deposits from December 2022 and announced plans to reduce its workforce by up to 25%, among other cost-cutting measures. Finally, on April 28th, First Republic was unable to access more funding after borrowing $121.3 billion from the Federal Reserve and FHLB funds. News outlets reported that the FDIC planned to find buyers for First Republic, and by May 1st, JP Morgan Chase had acquired a substantial majority of the bank's assets. Seriously, that's a very alarming situation. But why did the bank fail? And here's the catch. The collapse of First Republic Bank in 2023 was not an isolated event, but rather a result of a combination of factors that led to a catastrophic meltdown. One of the primary reasons was the bank's over-reliance on uninsured deposits, with more than 2/3 of its deposits being uninsured. When investors started to panic, This triggered a bank run, and First Republic was unable to manage the outflows. Adding to the problem was a lack of liquidity. First Republic invested heavily in real estate loans and municipal securities, which were less liquid and not earning competitive interest rates. As a result, the bank struggled to generate income from its assets. In December 2022, it had the highest ratio of loans and securities to uninsured deposits among mid-sized banks. Furthermore, First Republic faced repeated credit agency downgrades, which only added to investor concerns about the bank's stability. The downgrades reflected doubts that Infusions would resolve its challenges with liquidity, funding, and profitability. The broader mistrust in regional banks also played a role. Following the collapses of Silicon Valley Bank and Signature Bank earlier in the year, investors were increasingly concerned about keeping uninsured deposits with a regional bank. As First Republic's deposits started rapidly declining, the bank began borrowing from the Federal Home Loan Bank Board, FHLB, and Federal Reserve. It also accepted a $30 billion cash infusion from a consortium of 11 banks. However, these measures were not enough to save the bank, and its share price plunged from $122.50 on March 1, 2023 to $3.51 on April 28. Are you wondering if First Republic Bank's failure affects you? Then listen carefully. Well, it depends. If you don't bank at First Republic or own their stock, then you're in the clear. However, the FDIC is covering the $13 billion cost of this failure, which could impact other FDIC-insured banks. This means that your bank may raise fees or lower interest rates to help pay for the failure. If you did bank at First Republic, your account will change to JPMorgan Chase. But don't worry, you can still bank as usual, even if you had more than $250,000. If you're a stockholder in First Republic, unfortunately, it's not looking good. The stock has stopped trading, and you won't be given JPMorgan Chase shares. So, what can you learn from this news? The most important thing is to make sure your money is parked in an FDIC-insured bank account. And if you have more than $250,000 in any one bank account, it's a good idea to talk to a financial advisor about spreading your money out to multiple insured accounts. But there's an alternative perspective on this crisis. Some scholars think that this is good news because it shows that bigger banks are still interested in buying smaller banks, which could help the banking industry become healthier. Overall, this story shows that the banking industry in America is still facing some challenges, and it's not clear how things will turn out in the end. In a nutshell, First Republic Bank failed due to a high amount of uninsured deposits, lack of liquidity, and investors' mistrust of regional banks. As a result, the bank had to borrow from the Federal Reserve and accept a cash infusion from other banks. Those who didn't have an account or own stock in the bank were not directly impacted, but the cost of the failure may spread across other FDIC-insured banks. Those who did have an account with the bank will be transferred to JPMorgan Chase. The main takeaway is to ensure your money is parked in an FDIC-insured bank account and to consider spreading out your money to multiple insured accounts if you have over $250,000. Overall, while the bank's collapse had negative impacts, it serves as a reminder to stay vigilant about your finances and make informed decisions about where to keep your money. If you like our content, do subscribe to the channel for more updates, and do let me know your thoughts on this.